Will the stock market keep crashing in 2023? Certainly some people may think that, while others are predicting one of the strongest bull runs we've seen in a while. So what is actually going to be happening? So I'm going to be going over what all the major banks from JP Morgan to Morgan Stanley think is going to happen to the stock market. They have neutral predictions, positive predictions, negative predictions. I'm going to go over all of them. And then I'm going to give you my 2 cents of what I think might be happening to the stock market. All right, in the S&P 500, it stands for Standard & Poor's, basically 500 top companies in the U.S. They're all publicly traded, and they're the most popular companies among the stock market. And those include companies like Google, Microsoft, Amazon, Apple, and there's many more. So unless you've been living under a rock, you probably know that the stock market has fallen either 20% in 2022, and 2022 was basically a total bloodbath with most stocks losing a good portion of their value, including Tesla, I think, losing up to 70% of its value. So that catches us up to where we're at right now going forward. Now we're going to go over what these institutions are predicting for 2023 and where the S&P 500 will end up at the end of the year. So there's many factors that might influence these predictions for these firms, including the big one is a recession. Are we going to have a hard landing, a soft landing, or are we going to avoid a recession completely? And I'm going to go over the thoughts of these firms. I'm covering forecasts for neutral, positive, bearish, bullish, every scenario from the biggest firms in the country. But I'd like to start off with how interesting it is that the spreads this year are insane. It hasn't been since 2009 that we've seen spreads like this. There's a 35% spread between the lowest and the highest predicted yield for the S&P 500 for 2023. And it hasn't been since, like I said, 2009, which was the year after the housing market crash, which naturally no one would know what would happen after that. And it's interesting that we're also in the same boat once again. We don't really know what's going to happen next year. So it's important to know that right now the S&P 500 sits around 3,960, okay? 3,960 as of January 25th. I'm going to put a baseline in the top right corner. That way you can compare what these companies are predicting to the baseline in the corner. So first up is the companies with bearish forecasts, meaning they think the stock market's going to end down and down maybe significantly. They think we have a greater chance of not having a recession, and they're most likely predicting we have a decent level recession or even a hard landing, which means it's going to hurt a little bit. So first up is Barclays. They think we're going down. They think we're going to 36.75, and they're a multinational British bank, so they're one of the bigger dogs in the game. Morgan Stanley is an American investment and financial management institution, and they are predicting that we go down to 3,900 from where we're at right now, which isn't a huge difference, but they are predicting an earnings recession. And if we look at this article from Wall Street Journal shows that there have been 12 recessions since 1948. And since 1948, there have been 22 earnings recessions, showing us it's possible to have an earnings recession like Morgan Stanley is predicting without going into a full-fledged recession. And that's good news. So Blackrock, the world's largest asset manager, is predicting we land at a price at the end of 2023 at 39.30. Warning, investor optimism toward the stock market is coming too soon as the Fed is set to inflict damage on the economy. Basically, they're saying that people are buying stocks too early and they're getting into the market too early without actually knowing if the Fed is going to pivot and change course, which would be good news for the economy. They're basically saying that they think the Fed is going to knock the economy back down and people are not ready for it and invested in too early. But not all firms are expecting the market to take a hit. Some are expecting it to go up, but there are another group of firms that are expecting it to do nothing, and I'm going to go over the neutral group right now. So first up, Bank of America, one of the biggest banks in America, they're predicting the stock market ends around 4,000, saying their bull case is 4,600, but also their worst case scenario or their bear case could be down to around 3,000, which is a huge hit. But to me, it sounds like they don't actually know where it's going since their prediction was 4,000, or at least there's a lot of disagreements internally in the company where they're giving different price numbers for the predicted stock at the end of 2023. And this seems to be the case for most of 2023, as some people and analysts are predicting one way, as some are predicting other ways, but nothing's really super bold. Like, think of it as if you're giving an easy prediction that you're going to be right most of the time if you don't say anything crazy and just keep it simple. And that's what these analysts are doing. That way they're right most of the time so they can keep their job. But hopping into another neutral outlook would be Goldman Sachs. I'm going to take a look at their 2023 outlook report that they go over their expected economic conditions. But first, it's important to understand how the Fed can influence the stock market. Increasing rates can hurt the market, but also decreasing rates can help the market quite drastically, including a pivot. Yes, I'm going to be talking about the pivot really quick and just taking a look at LPL's article Playbook for the Pivot. Once the Fed pivot and starts taking rates back down, historically the stock market has closely followed, with growth stocks performing the best. So backtracking to Goldman Sachs economic outlook for 2023, they aren't really expecting a Fed pivot until May of 2023. And if that's the case for their neutral prediction, that must mean the stock market's going to go down for a while and then level off around May, around the Fed pivot time, and then head back up, closing around 4,000 if their prediction is correct. But not everyone has a negative outlook for 2023. We just look at JP Morgan. So Morgan is predicting 4,200 for the close of the S&P at the end of 2023. And they are saying that it is possible that volatility will keep remaining high throughout the full year. They say we expect the S&P to retest last year's lows while the Fed over-tightens into weaker fundamentals, saying this sell-off, combined with disinflation, rising unemployment, and declining corporate sentiment, should be enough for the Fed to start signaling a pivot, subsequently driving an asset recovery and pushing the S&P to 4,200 by the end of 2023. But that's interesting considering their CEO, Jamie Dimon, is expecting interest rates to be around 6%. And if the interest rates are around 6%, which is higher than what the Fed members are actually predicting it will be, you would expect them to have a bearish outlook on 2023, and they actually have a bullish outlook at 4,200. So it makes you think, what is kind of going on in there? Or maybe the CEO has nothing to do with the analyst, and he probably doesn't, to be honest. But not all companies are even expecting a bad year, as Oppenheimer and Wells Fargo are expecting to end the year at 4,400 for the S&P 500, which is above the average return of 9% for the stock market, which puts it around 10%, which is quite incredible considering the terrible year we have and high inflation and high interest rates. Wells Fargo, their prediction actually 4,500, says our single and consistent message since early 2022 has been to play defense in portfolios, which practically means making patience and quality the daily watchwords. As we await an economic recovery, the long-term investor can use available cash to add incrementally in a disciplined way to their portfolio. And overall, I agree with Wells Fargo. I don't think S&P will return 10% this year, but I think dollar cost averaging into indexes is still a great move for people that are less experienced. Historically, they have performed great without tons of experience, and they have shown tremendous results. Warren Buffett has famously said, if you like spending 6 to 8 hours per week working on investments, do it. If you don't, then dollar cost average into index funds. And who am I to say don't listen to the GOAT? So I think the market will start to turn around March to May area when the Fed begins their pivot, or that's when I'm predicting a pivot because of the recent PPI data was pretty good. I think we're going to have a good 2023, maybe not super bullish, but I do think it'll be a positive year for the overall market. I am no financial advisor and I am no financial wizard, but I think 2023 will be a good year, and I hope this video was helpful. If it was, please leave a like and subscribe, and I'll see you on the next one.